Okay, hi everyone. It doesn't get much sadder than this. I'm at school, it's 4:30. The cleaners have already been in, they've already seen me talking to myself. I'm pretty embarrassed. But I'm doing this because I care about you a lot. So here is my first video for you. It's on monetary policy, right? And what you're going to know is definitions, diagrams, and R-buts. Enjoy. Okay, here we are. You've got to start off with a definition, and if you can't do a good definition, the examiner's going to think, right, you're a bit of a joker. So you need to get this right. So, first of all, this at the top is the definition. The only bit you care about is the bit about changing the base rate. But just because you don't care about the other two bits, just because you're not going to talk about them, doesn't mean you shouldn't put them in there. You have to talk about the base rate, the money supply, and the exchange rate. Now, when you get to A2, when we talk about the money supply, we're talking about something called quantitative easing. But we're not doing that now. And the exchange rate, we're going to do later on in the course. But for the minute, don't worry about those two bits. What matters most is monetary policy refers to changes in the base rate. Now, as you remember, the Bank of England set the base rate to try and make sure inflation stays around about 2%. In the UK at the minute, inflation is 2.2%. The Bank of England are actually quite happy with that because, although they say they want it at 2%, they'll have 2% plus or minus 1%, which means basically if it's between 1 and 3%, they're pretty happy. Alright, this is the important bit. Now we want to have an actual example of what might actually happen. So here we've got inflation at 5%. It's not 5%, it's 2.2% in real life, but just pretend it was 5%. I want you to pause it and think about what the Bank of England would do if inflation was at 5%. Okay, now you've paused it, you're probably starting again. They would put the base rate, I know it's a bit scary, they'll put the base rate up. I hope you got that right. So they'll put the base rate up because they want to try and reduce demand in the economy, which will hopefully reduce inflation. Okay, so the base rate was 0.5%. Maybe they'll put it up to 1%. So what effects will this actually have? There are 4 major effects that you need to know about. And they're all pretty easy. I think you know most of them. First of all, people will spend less. Do not just write spend less. That would be such a low point. You spend less using credit. So they're not going to use loans or credit cards. Or they might still use them, just to a lesser extent. The reason is, less people will want to take out loans if they have to pay back more interest on that loan. The next one is they might save more. By saving more, that means they might put their money in the bank because they're going to get more interest on their money. The third thing is, and this is the one that matters to me, is it will affect their affect their mortgage interest repayments. Okay. I can't read that, but that's meant to say repayments. Okay, mortgage interest repayments. An example for you is, at the minute I pay £930 on my mortgage. If interest rates were to go up, I'd cry. But whilst crying, I'll have to pay £1,000 or something like that on my mortgage every month. That's because the interest repayments have gone up. This will obviously mean I've got less money, which will obviously mean that I won't be able to spend as much in the economy. And then the fourth thing is firms, and I'll change colour for this, firms are less likely to invest. And the reason is, again, a lot of firms, especially at the minute, will need actually banks' help to invest, so they'll need to take out a loan. And if interest rates are high, they're going to have to pay back more on that loan, so they're less likely to want to do it. Right, so continue from that example. All those factors cause AD to go down. So the diagram you draw in the exam is, you'd say, because the government have put up the base rate from 0.5%, I'll just change colour, to 1%, we've decided this is going to cause demand to go down. So you draw your diagram, you have price level, you have real GDP. Write them first, it's a lot easier to. You're always going to use your curvy line, apart from in the cost push inflation diagram, but you're always going to use that curvy line. And then you'd have, in the economy, demand was doing okay, it's up here. And the reason why the government were worried was because the price here was quite high. So what they decided to do was try and get demand to go down in the economy. So demand's gone down to here, AD2. Let's get all the dotted lines in. Y1, Y2. Right, okay, so once you've done your diagram, you've explained this is what should happen in the economy. a good thing to say now is this actually good for the economy or bad for it? And what you think about is you think about Tiger, because that's what we look at when we decide if the economy is doing well or not. Right, is it likely to be good for, I'll get my highlighter out, is it likely to be good for trade balance? Now if you look at this, prices have gone down. So if prices go down, our goods are therefore more competitive. So what we're deciding is that would be good for trade balance. Secondly, is it going to be good for inflation? Again, prices have gone down because there's been a reduction in demand pull inflation. So again, we can say it is good for inflation. However, there are two bad things here. What we've got here is I'll just change colour pen, we've got Y going down. So we've got output in the country going down. So first of all, that's bad for growth. And secondly, if output's going down, that means there's less demand for workers. So because demand for workers is derived from demand for goods and services, so therefore employment will be struggling as well. There'll be more unemployed people. So what this shows is this technique to try and solve the economy has got some good things, but it's also got some bad things. Right, here's the final section, and it's really important. It's probably the most important section, and it's the R but section. By the way, whatever you do, don't write R but in your exam. This is just a way of me actually explaining it. There's nothing worse than someone in capitals writing R but. So, these are your evaluation points. These are the things that get you above 13 marks out of 25. You need these points. And here they are. So basically, the base rate has gone up from 0.5% to 1%. What possible reasons would this not actually have an effect? And here are some of them. The first one is there could be a time lag. And there could be a time lag normally of 2 years. And the point of this is that say the base rate went up. Normally, as I said before, I'd be worried because my mortgage interest repayments might go from £930 to £1,000. But I'm actually on a fixed rate mortgage for 2 years. So at the end of those 2 years, I'll have an effect. But at the minute, when that interest rate changes, it won't make a blind bit of difference. I'll still be paying £930. Second point, it depends on how big a change it is, so size of change. As you can see there is only a 0.5% difference. So actually, this small change might not actually have that big an impact on the economy. A third thing you might be able to say is that if at the same time as interest rates going up, taxes went down, it might counteract this thing. So things need to be done in conjunction. It can't just be interest rates on their own. You also have to think about taxes. And then fourthly, and this is the final one I'm going to try and say today, is in the current crisis we have in the economy. So from 2008 onwards, changes in interest rates haven't actually worked. So they used to be a useful policy, but lately they've not worked. Right, that's basically everything I wanted to try and explain on monetary policy. If you're struggling with bits of that, rewind and try and see what it is that you're not quite getting. So hopefully you'll come to the next lesson understanding it a little bit more.